Early withdrawals. I got a ton of questions on Roth IRAs last night on my first ever live Q&A, and I still get tons of questions on the YouTube channel, the blog posts and whatnot too, just about withdrawing from IRAs. Some of the information out there is wrong. There's just no other way around that. So let's dive right into this, and we're going to look at an article from the Motley Fool. Motley Fool gets a lot of bad raps, and I think partly because they're so heavily on the sales side of man, I signed up for Motley Fool so you don't have to. And man, I was getting solicited every which way to Sunday. I think because I didn't open the email after 3 weeks or so, they stopped sending me stuff. I don't think I unsubscribed. Maybe I did. I can't remember. Anyway, but they have a lot of good information out there. And, they have a huge page authority because if you type in Roth IRA withdrawals, you're going to get something from the Motley Fool. Now, I got no problem with that. They do provide a good service for education. Just be advised, if you sign up for this stuff, you're going to be hit up hard. So just keep that in mind. So don't forget to subscribe down below. As always, comments, thumbs up. The whole thing helps me with the YouTube algorithm. And then for subscribe. Did I say subscribe? Sorry. So let's read this. I was reading another article the other day, and the info was just wrong what the lady was talking about, and that kind of bothered me. And I said, well, I was going to do there we go. I was going to do an article, video on this, what she said. And I just said, let's just read some of this from the Motley Fool because I actually a lot going on here. The IRS does not care from which Roth you take a withdrawal. So unlike a 401k, if you have multiple 401ks or employer retirement plans, you have to take IRA distributions, required distributions from each. You can't just consolidate them into one. And in a Roth IRA, you can. They don't care. They can say, look, you got 4 different Roth IRAs. We don't care from which it comes from. There is no required minimum distributions for the owner of a Roth IRA anyway, so it doesn't matter. But just remember, if you have a bunch of Roth IRAs, they don't care from where it comes. If you have multiple IRAs, they are considered as one Roth for withdrawal purposes. Further, the IRS has deemed that the Roth IRA distributions must be withdrawn in a specific order. And this is important to understand. They should be made in the following order: from non-taxable annual contributions to a Roth, from conversion contributions, FIFO, first in, first out, and from earnings. That's huge. I'm telling you. Non-taxable annual contributions. So the money you put in there is your cost basis, essentially. Conversion contributions and then earnings. So earnings come out last, always. So the withdrawals from your Roth are earnings last. That's huge. Penalties on earnings from contributions. Unless an exception applies, most distributions from a Roth IRA before the owner hits 59.5 will be subject to an early withdrawal penalty of 10%. Just keep that in mind. But that I cannot stress this enough. Most distributions of earnings from contributions. Okay, so we're going to dive into that, a couple examples here, which is why I like using this article. Be very careful not to confuse the early withdrawal penalty with the taxes imposed on non-qualified distributions. So you have early withdrawal penalty, and then you have the qualified withdrawal, which is tax-free, and then you have the non-qualified distribution, which is tax-free. The non-qualified is taxable. So be careful not to make the mistake. You're gonna if it's non-qualified, you're gonna pay income tax. If it's non-qualified and before the age of 59.5, you're gonna pay income tax and a 10% penalty. If it's qualified, it's completely free. Does that make sense? You got 3 things: qualified, non-qualified before the age of 59.5. I know that's confusing, but stay with me here. All right, so here's Jim. Age 30, made a Roth IRA contribution of $2,000 in 1998. In 2005, his Roth has a balance of $3,500. He decides to close his Roth in a non-qualified distribution that year. Since the distribution is non-qualified, all right, because then remember, he's non-qualified distribution. He's not 59.5, and he has not held his Roth for over 5 years. So thus, it's a non-qualified distribution. He will owe taxes on his Roth earnings of $1,500, and it'll be taxed as ordinary income. In addition, since the distribution took place before he's 59.5, and because he did not meet any of the exceptions, we've talked about the exceptions a million times a Sunday. Basically, there are no exceptions unless you're hurt or dead. Your spouse inherits it dead. There's just the exceptions are few and far between. But because he did not have exceptions, he'll be also assessed a 10% early withdrawal penalty on what amount? is going to be amount on that $1,500, not the $2,000 he put in, but the $1,500 of earnings. So if we assume that Jim is in the 28% tax bracket, he'll pay $420 tax on the earnings, and he'll pay a penalty amount of 10% on the earnings as well. So what has happened here? He started with $2,000. He's 30 years old. It's now worth $3,500. He closes the whole thing out for whatever reason. That $2,000 he started with goes back to him without penalty or taxation. The $1,500 does not escape that. It is taxed at ordinary income, and he pays 10% because he's under the age of 59 and a half. That's a non-qualified distribution before you're the age of 59 and a half. Exceptions, and here's the exceptions. Because of owner's disability, I'm telling you, I've talked about this a couple of videos not that long ago. It is like they say, very narrow your disability. I think you even have to have a doc sign off. I can't remember. But look, it's going to be tough to be considered disabled to get the exception. It can happen. It's just going to be tough. Death. The IRA owner's death. Again, you inherit the IRA, a Roth, or a traditional. Then there are exceptions to the penalties and the taxes. A series of substantially equal periodic payments. That's called 72T. If you basically annuitize your Roth, you can take that annuitization even if you were 459.5 without paying the penalty for sure. Unreimbursed medical expenses, I think it's 10% now, so I don't think Molly Fool has updated it. So again, it's going to be tough to get the unreimbursed medical expenses because it got to exceeds 10% of your AGI. There are a couple other things I just don't want to go into because it's just not that many. Penalties on conversions from a traditional IRA to a Roth. The penalty rules regarding conversions are a bit different than those for annual contributions. I'm telling you, this is huge, huge. So remember, we just did Jim. He was doing contributions. These are conversions. All right, the penalty rules regarding conversions are a bit different than those which from annual contributions, which may be taken at any time for any purpose as free of income taxes and a penalty. An early withdrawal of a conversion contribution has a different twist. All right, so remember, annual contributions can be taken at any time without penalty or taxes. That's contributing. Conversion is different. I'm moving money from a traditional IRA. I'm converting it to a Roth. These are different. The early withdrawal penalty applies to a distribution of conversion money from a Roth IRA when the distribution is made within the 5-year tax period, starting with the year the conversion was distributed from a regular IRA. Only to the extent that the distribution is attributable to the amounts that were included in the gross income as a result of the conversion. So I cannot stress this enough. Well, here, they give us an example. Paul made a $20,000 conversion from his regular IRA to his Roth in 1998. The entire amount was included in Paul's income in 1998. Paul made no additional contributions or conversions into a Roth in 1998 or later years. In 2001, before he is 59 and a half, he withdraws $10,000 from the Roth. All right, so remember, he started with $20,000 in 1998. 3 years goes by, and he takes $10,000 out after he made the conversion. Paul will pay no tax on this withdrawal because he paid income tax on the full $20,000 he converted in 1998. However, he will pay 10% penalty because there's no exception. Why? Because he did not keep the conversion amount in his Roth IRA for 5 years. All right, so that's a huge issue. The one I wrestled with a lot, actually, which I don't think a lot of people understand. Your contributions to a Roth are always free and clear without tax or penalties. Your conversion amount contributions, and again, I hate to even say the word contributions, but your conversion amount, you move $20,000 from your IRA to a Roth. You paid ordinary income tax on the $20,000. 3 years goes by, and you pull money out of that. That is not free and clear from the early withdrawal penalty, the 10%, if you're under the age of 59 and a half, because you haven't had it open for 5 years, okay? Now, if you've had it open for 5 years, we're going to talk about that. But just remember, those contributions are not free and clear of taxation. I should say the early withdrawal penalty because you haven't had it open for 5 years. Hope that makes sense. So if you're going to take funds early from your Roth IRA, weigh your conversion carefully, very carefully, especially if you made a non-deductible contribution to your original IRA. All right, so I remember when I was at this when I actually left Vanguard. I remember I thought when I left USAA just a couple of years ago. I said I'm going to move money from my 401k, which I rolled to an IRA. I'm going to convert it, and then I'm going to tap into the contributions of that Roth IRA before the 5-year threshold was, thinking I could be a snake in the grass and say, look, it's contributions. I pay tax on it. The IRS does not look at it like that. The IRS would say, Josh, if you took $20,000 out from your Roth IRA, which was funded by a conversion amount just 2 previous years ago, you're going to pay penalties on that $20,000 because you're under the age of 59 and a half. It hasn't been open for 5 years. Under the age of 59 and a half, you're going to pay 10% penalty on that. Now, here's the kicker. What if I did a conversion 6 years ago? All right. So 6 years ago, I converted $20,000 from my traditional IRA to my Roth. All right. So we'll say that's in 2013. 2018 comes back around and I do another conversion into that same Roth IRA. All right, so I did 20,000 in 2013, and in 2018 I do another 20,000. So I have 40,000. Let's say I got no earnings. I have $40,000. Can I take that full $40,000 and have it free and clear without any taxes or penalty? No, because the IRS looks at that conversion being 2 unique 5-year periods. I know this is confusing as all can be, but conversion 1 that I did in 2013 is now free and clear from penalties. Absolutely. Conversion 2, which I did in 2018, is not free and clear from penalties. It's not, because it hasn't had its own unique 5-year rule. And I'm just telling you right now, that's something that I had thought about myself. I said, well, if I open a Roth IRA in 2013 and convert it all in 2018, I have beaten the 5-year minimum. And so I should be able to have access to the contributions free and clear of any penalty. And the answer is no, you can't. I'm telling you, you can't. It has to be each individual conversion is its own 5-year rule. Hope that makes sense. Because a pro rata part of your withdrawals from a regular IRA is treated as coming out of non-deductible contributions, but amounts withdrawn from a Roth IRA conversions as treating out of as coming out of the income taken into account of the conversion first. All right. So again, I just cannot stress enough. A conversion done in 2013 is now 2019. That is free and clear to take your contributions out. That's a fact. If I did a second conversion in 2018 and commingled that second conversion with the one I did in 2013, the 2013 amount is still free and clear, but the 2018 is not, even though that Roth IRA has been open for more than 5 years. I hope that makes sense. Karen has a traditional IRA with $12,000 in it. 6,000 of that was from a prior year deductible contributions and total IRA earnings. The other 6,000 represents a non-deductible contribution. She's contemplating a Roth conversion, but she wants to take a distribution of $4,000. Her options are as follows. She can leave her money in the traditional IRA and take a $4,000 distribution. She'll be taxed on the distribution of $2,000 because half the account is deductible earnings and contributions. She'll also pay a 10% penalty, but only on the $2,000 because that is what is that is what was deductible to contributions earnings. The other $2,000 is tax and penalty free since it came from prior non-deductible contributions. So again, a non-deductible contribution to your IRA is the same thing as Roth contribution. It is free and clear of taxes and penalties. But unlike the Roth and a traditional IRA, it is pro rata. So they're going to give you the $4,000 in this case for Karen, but there's some of it's going to come from her non-deductible and some of it's going to come from her deductible account, pro rata, which means some of it will be taxed and some of it will be also subject to the 10% penalty. Confusing as all can be, I get it. She can convert the entire traditional IRA to a Roth and then take a $4,000 distribution, but this is a bad choice. Once she takes the $4,000 distribution, she'll be subject to a 10% penalty on the entire distribution, or $400, because of the ordering rules. She won't have to pay any tax on the distribution since the tax was paid when she converted, but making this choice causes her to pay an additional $200 penalties that can be avoided with just doing proper planning. On the other hand, if you're reasonably young and expect to need withdrawal funds from your IRA in 5 years and can't use the 10% exceptions, you might be better off converting funds from your regular IRA to a Roth now. If you wait until after the 5-year period to withdraw money from the Roth, the 10% penalty will not be imposed on your contributions. All right. That, or in this case, the conversion amount. And again, the ordering is the amount you put in always comes out first. All right. So as long as you're not touching the earnings, you won't pay any taxes on your contributions amount. And if it's been over 5 years, you won't pay any 10% penalty either. Why? For a Roth IRA, you've met the 5-year tax year exception on the converted funds and therefore dodge the 10% penalty on these distributions. Again, even though you're under the age of 59 and a half. But there's no 5-year tax exemption for a traditional IRA. So while you still pay tax on the earnings in either case, again, if you don't take earnings, you don't worry about it. In this case, you would escape the 10% penalty by converting to a Roth, again, so long as you held it for 5 years. Another example might be an order. Rick converted $15,000 from his traditional IRA to a Roth in 1999 and another $20,000 from his second traditional IRA in 2003, just like what I was talking about just a second ago. These conversions were all taxable to Rick when they occurred because he had not made any non-deductible contributions to his traditional IRAs, i.e., he made them all deductible. He has no other Roth IRAs and has not made any additional contributions to his Roth since the conversions. All right, so we got 1999 conversion, 2003 conversion, and now 2006. Rick is still under the age of 59 and a half. So let's just say his old Josh, your buddy Josh. I made a conversion in 1999. I made another one in 2003. Now it is 2006. I'm 49 and a half, under the age of 59 and a half. And I want to take a $15,000 distribution of my Roth, which consists of $15,000 from 1999 and $20,000 from 2003. Is this distribution subject to tax? No, because I've already paid tax on the conversion amount. However, the distribution is not, is this distribution subject to 10% penalty? No. Why? Because the first conversion I made in 1999 was for $15,000, which is the amount I'm taking out, which has been over 5 years. I hope that makes sense. So it's 2006. I converted $15,000 6 years ago or 7 years ago. I have access to that $15,000, my contribution, again, my conversion amount. I hate to say it, but it's kind of synonymous in this regard. And because it's been over 5 years, I have access to it. What if I took a distribution of $20,000 though in 2007? In this case, the first $15,000 is still free of clear of any taxes or any penalty because I did do a conversion of $15,000 more than 5 years ago. But the next $5,000 is not, because the second part of the conversion was done less than 5 years ago, which meaning $5,000 of my $20,000 distribution is not subject to taxes, but it is subject to the 10% early penalty. And again, you got to understand how this works. It's a big deal to get this right. Let's see. If your Roth IRA consists only of contributions or only conversions, these rules aren't too difficult to follow. But if your Roth consists of contributions, conversions in different years and earnings on both, then the qualified distribution rules and penalties can get very complex. So you really need to know the tax impact of the Roth IRA. I completely agree. So let's wrap this up. You have a Roth contribution. I put $10,000 in over 2 years. It's worth $20,000. Let's say $15,000 now. I want to take $10,000 out. I can do that without taxes, without penalty. No, there's no other issue on that whatsoever. None. I have $10,000 contributions. The account's worth $15,000. I want to take $15,000 out. First $10,000 is free and clear of any penalty and any taxes. The next $5,000 is going to be subject to two things. If I'm under the age of 59 and a half, a 10% early withdrawal penalty and income taxes because it's not a qualified distribution. That's on contributions. So you got to keep a number of how much you've actually contributed, and that will come out first. And the minute you go above that contribution amount, it will be subject to taxes and or a 10% early withdrawal penalty. Part two, I did conversions. I've done conversions each and every year. Each conversion has its own 5-year time frame. So you do a conversion in 2013. It's now 2019. The conversion amount I did is completely free and clear of any taxes or penalty. The conversion principal, not the earnings. 2013, I converted $10,000. It's now worth $15,000. That $10,000 conversion I made, I can have access to it. The $5,000 in earnings, I cannot. I did a conversion in 2018 for $10,000. The account is, let's say, dropped to $8,000. It does not matter. It is still going to be subject to the 10% early withdrawal penalty because it hasn't been 5 years. A lot to chomp on there, my friends, but you got to know the rules of the road when it comes to Roth IRA early withdrawals. Remember, 3 things. Qualified, you had to open for 5 years and you're over 59 and a half. The entirety is tax-free. Non-qualified, you haven't had it open for 5 years. If you're over 59 and a half, but it hasn't been open for 5 years, you'll pay taxes on the earnings that you've made. If non-qualified and under 59 and a half, you're going to pay taxes on your earnings, obviously, and you'll pay a 10% penalty on your contributions as well, as long as you haven't had it open for 5 years. So a lot to chomp on there. Just remember those 3 things. And if this helps, don't forget to subscribe down below. I'll put a link to the show notes of this article because I think it's actually one of the better articles on this right here. And always comments, questions, thumbs up always help me a lot. So don't forget to subscribe. And we'll see you next time at the Heritage Wealth Planning YouTube channel. Thanks, guys.